You're listening to What the Sigma with Chad Stacks. Today on the show, nearly 50 grand for a new car, a million buyers who've already walked away, and the bond market's finally catching on to a con that's been hiding in plain sight. We're breaking down how the auto industry stretched loans to 84 months to hide affordability crisis and why the safest bets in auto finance are starting to crack under the weight of rising defaults. Aaron Keating said the quiet part out loud. The Cox Automotive executive analyst, in the same KBB release that headlines affordability improving year over year, wrote that today's pricing is being supported by supply discipline and mix, not demand strength, and that volume is absorbing more of the pressure. That sentence is doing a lot of work. Most reads on April auto data stopped at the headline number and called it a soft landing. Keating's own quote is not a soft landing story. It is a controlled descent story, and there is a difference. Let me put the April print on the table. Average transaction price, $49,461, up 0.7% month over month, up 1.8% year over year. The year-over-year number is below the 3.6% long-term average, which is where the soft landing framing comes from. Monthly payment, $757, up 1.3% from March. Average auto loan rate on a 72-month note, 9.45%, up 9 basis points in a single month. Weeks of median household income required to buy the average new car, 35.2, up from a revised 34.9 in March. So affordability is improving year over year, but it got worse month over month in April, the month the data is actually describing. The year-over-year improvement is lapping a worse comp. The mom deterioration is the live read. The 1.8% annual price growth looks like normalization. Keating says it is mix, not demand. What that means specifically, luxury buyers pulled back, the volume mix shifted toward high unit count segments like SUVs and pickups, and the average moved accordingly. The price moderation is not buyers getting relief. It is a different set of buyers showing up in the denominator. The underlying unit demand is deteriorating, which is precisely what the 1M lost buyers headline from Autoblog and Governing is describing. Two different data cuts, same signal. That 1M number deserves a second. The U.S. new car market has shed roughly 1 million prospective buyers since 2020. Two independent outlets confirmed the figure in the same week. The detail on methodology is thin because neither source article was extractable, so treat the number as directionally confirmed, not precisely sourced. But the direction is consistent with everything else in the April data. Incentives declined month over month in April, even as sales volume fell against both March and April of the prior year. You do not pull incentives while volume is falling unless you are deliberately managing price over volume. That is supply discipline. That is Keating's quote made operational. Here is the part that is not getting covered in the consumer-facing reads. The industry is not cutting prices to recover lost buyers. It is extending loan terms to hold the monthly payment optically near $757 instead of letting it break $800. J.D. Power published a piece on the rise of 84-month financing and what they are calling a new negative equity cycle. That is a 7-year car loan. The average new car in April cost $49,461 at 9.45% over 84 months. The math on that note is not comfortable, and it is being written at origination, with negative equity from the prior trade-in rolled in, meaning a meaningful share of new car buyers are underwater before they leave the lot. We will come back to what that means for the next trade cycle in a minute. The peak monthly payment was $795 in December of 2022. The current $757 is being framed as 4.9% below peak, which is technically accurate and strategically incomplete. The mechanism that produced the $38 of relief is not a price cut. It is a longer loan. You did not get cheaper transportation, you got a longer sentence. Now the credit layer. Bloomberg reported that the safest tranches of auto loan asset-backed securities, the AAA-rated paper, are weakening as borrower delinquencies rise. That piece was not extractable, so I am treating it as headline-level signal, not granular data. But the direction matters disproportionately. AAA Auto ABS is the tranche that pension funds and money market-adjacent vehicles hold. It is supposed to be the part of the capital stack that does not wobble. When it wobbles, the funding cost for the captive lenders, Ford Credit, GM Financial, the Toyota and Honda captives, goes up. When captive lender funding costs go up, the rate buy-down lever, which is how OEMs manufacture below-market financing offers, gets more expensive to pull. The $757 payment depends on that lever staying available. If the AAA tranche stress is real and it widens spreads across the auto credit stack, the industry loses its primary affordability engineering tool at exactly the moment the consumer is already stretched to 35.2 weeks of income. The S&P Global read for May called sales relatively steady, which sits in tension with KBB showing volume declining against both the prior month and the prior year's equivalent month. The reconciliation is probably that SAR, the seasonally adjusted annual rate, held while underlying retail demand softened. S&P is reading the macro print, KBB is reading the retail floor. Both can be true. The one that matters for OEM earnings and dealer valuations is the retail floor. Nobody in the extractable data set breaks down who the missing million buyers actually are. If they are subprime borrowers priced out by the rate environment, that is an ABS story concentrated in the riskier tranches. If they are young, first-time buyers who cannot get to a down payment at $49,461 average, that is a generational demand story with a 20-year tail. The distinction matters enormously for how you model the recovery. A cyclical demand gap closes when rates fall. A generational demand gap does not close when rates fall. It closes when the product portfolio resets around a different price point, which no major OEM is currently doing at scale. The 84-month loan math compounds this. If you originate a 7-year note with negative equity rolled in today, the trade-in window for that buyer opens somewhere in the early 2030s, and they arrive at the dealership underwater on their current vehicle, with less purchasing power than they had at origination, in a market where the average transaction price has presumably continued to drift higher. J.D. Power named that the new negative equity cycle. It is not a cycle in the sense of a temporary pattern. It is a structural drag that compounds each trade-in period. The lost million of today becomes the constrained trade-in cohort of the next decade. The equilibrium the industry is running right now, hold ATP near $49,500, let volume erode, use term extension to keep the payment optically tolerable, works precisely as long as every major OEM holds the line on supply discipline. The first brand that decides to chase volume with real price cuts, not rate buydowns, not incentive noise, actual sticker reductions, breaks the whole thing. Every other OEM then faces a choice between defending margin and defending share. That is not a hypothetical. That is the standard endgame for coordinated supply discipline in a demand erosion environment. Someone always blinks. The April data reads as a soft landing if you stop at the year-over-year headline. Keating's own quote, the Bloomberg ABS headline, and the J.D. Power financing analysis are all pointing at the same underlying condition. The affordability gap is real, it is being managed rather than closed, and the instruments being used to manage it are starting to show stress in the credit layer. A market that has lost 1 million buyers while holding price through supply discipline is not normalizing, it is deferring. What the Sigma? Follow our show if you want the alpha before everyone else. Nothing here is financial advice.
Grab news. Thomas.